Hello, everybody. Welcome to today's webinar, where we will be reviewing the voluntary carbon market in the first 3 quarters of 2022. Thank you all for joining us here today. And this webinar is being recorded for your colleagues that could not be here with us. Our speakers today will be Guy Turner, our CEO and founder, Gregoire Mazar, lead analyst, Teresa Bodner, lead analyst, Delphine Stringer, analyst, Hassan Cuthbert, analyst, and I'm Tanya Bora, marketing and account manager. Before we begin, I would like to go over a couple of house rules with you all. All attendees are automatically muted and the chat has been disabled. Should you have any questions during the presentation, please submit them using the Q&A box at the bottom of your screen. I'll pass over to Guy.
Am I on mute? Are you unmuting me?
Hi, sorry. Guy, could you please start again?
Yeah, okay, fine. Sorry about that technical hitch. Welcome to everybody. I hope there's people on the call who have participated in the first 2 quarter webinars that we do. Bit of a tradition here at Trove. We try and inform the market and broader the universe that's interested in what corporates are doing on climate change. And we hope to sort of illuminate sort of where we stand at the moment. Some updates from our side on the Trove. For those who've been following the web presence, you will have noticed that we've actually launched a new website. And so congratulations to the team here for getting that over the line and pushing it out. It includes a lot more functionality. The free content that's available is the same, but has sort of changed location. So for clients who subscribe to the private platform, there's a lot more content, a lot more navigation, easier navigation with improved dashboards. But for those on the looking for public content, all of our reports, commentaries, strategic guides are now housed on a separate page on the new website, so much more easy to find and hopefully more useful. We've also launched and are able to provide direct data feeds for a lot of the data and analytics that we make available is now available through direct data feeds for incorporation into client systems. So do talk to our team about that. And there's a whole host of interesting functionality coming down the line. One of the interesting areas we've been working on is assessing individual project developers' performance and profiles under the projects and transactions modules. A fair value tool that allows traders to identify the actual price that a particular type of project and vintage and attributes will be able to trade at, and a whole range of other interesting features. So please do contact us for more information about that. And we look forward to being in contact. So first off, one other thing, we have provided freely now the Trove Research Carbon Industry Classification methodology system, which we've been using for a couple of years. We've updated it just recently. This is a system that sits across all of our modeling and analysis within the company: demand, supply, prices, etc. And now it includes 3 levels of classification. It's super important. This goes down to the methodology level within each registry. Different sort of registries and standards apply slightly different definitions, and our role is to consolidate those and standardize those in a single system that makes sense. We've expanded the carbon removal technologies, the engineered solutions, added blue carbon in a systematic way. And the other reason for doing this is that we can make sure that we are capturing removal and reduction type projects and technologies in a very systematic way, because the distinction between removal and reduction is very important for a number of reasons, not least SBTI requirements, and a number of companies very keen to invest in removals. And the other sort of lens that we're applying to this, although it's not featured in this particular this particular table, is the definition of high quality. And we've been doing quite a lot of work looking and modeling the segment of the market that can be uniquely classified as high quality. And what does that slice of the market look like from a demand point of view, and a supply and a price as a subsector of the overall market? And that work will be coming out as part of our latest quarterly price scenarios that we first published in June, July this year. The update of that is coming out very shortly. So a lot of things happening this end, and a lot of interesting new content. So standard structure that we use in these quarterly webinars now, looking at corporate commitments, changes there, review of carbon credit transactions, pricing, update on the policy landscape, and then our audience poll on where we think prices are going to end up. So quickly then on corporate climate commitments, as our clients will know, we track the commitments of over 6,500 companies. This is just the SBTI data, but on this, overall we have 3,700 companies now approved with an approved SBTI net zero target, or committing to set one in the future. That's an increase of 553 on the end of Q2 22. So on the left-hand chart, the cumulative number of companies that are making those commitments, and that looks very positive. When you look at the economic climate that's sort of challenging governments and companies around the world, that's really quite an interesting and positive trend. The right-hand chart shows the month-on-month change in company commitments, and the line to focus on is this purple one here, with 263 companies setting a 1.5 degree target under the SBTI framework, which is really quite remarkable. That is the highest number of companies that have set a target within a quarter, so not month to month, quarter on quarter, since the system was launched 3 years ago. And that is in the face of this the economic headwinds we have today. The other interesting aspect of this is the grey one here, of companies that are committing to set a target at some day in the future, has actually dropped from over 350 to 248. So that can be regarded as a leading indicator of where the number of companies setting hard 1.5 degree targets may go in the future. So that's something we'll be looking at very closely in Q4 and trying to pick up a pattern there. Some of the companies that have made the headlines under the SBTI system are big, well-known companies. Sony, just to pick a few, Telefonica, HP, Lufthansa. Interestingly, 3 airlines here, Lufthansa, JetBlue, and EasyJet. EasyJet hit the headlines for other reasons recently, retracting their commitment to using carbon credits in the short term to offset their emissions, but still having their net zero target in the longer term verified and under the SBTI. And it's not moving away from climate change at all for that company. It was quite interesting to read their own research that 3/4 of the public, according to their survey, 3/4 of the public think that companies need to urgently set out how they'll achieve net zero this century. And as a response, the company is committing to using more sustainable technologies, sustainable aviation fuels, etc. So where companies may be sort of taking a pause from the carbon credit world, we don't see any evidence of them walking away from their climate obligations and commitments. If not, that trend the trend towards technology solutions seems to be gathering pace. And I think that is a wholly positive trend, particularly in the light of COP27 that's coming up shortly, and all of the news coming out, in the last week from the scientists about how important this COP is to cement the commitments that were made in Glasgow last year and move forward. So that's some of the corporate action that's going on, and I will hand over to my colleague Hassan, who will talk through some of the market dynamics at the moment.
Thank you very much. Yeah, so this chart shows the issuances by project type, as I'm sure many of you are familiar. As you can see, Q3 saw a decrease on the number of issuances on Q2, marking the 5th consecutive quarterly drop in issuances. This marks a trend of falling issuances now for over a year. The year-to-date issuances are 30% lower than last year's first three quarters issuances at around 203 megatons. Q3 issuances alone, which are 54 megatons, mark a 25% drop on last quarter. Given the current financial situation, there is a level of cautiousness exercised among the credit issuers following drops in credit prices in the second quarter of the year, especially for nature-based credits, which would normally expect a price premium. This decrease in issuance volumes stems from across all project types, but is acutely attributable to REDD+ projects, the darker of the greens, only issuing 4 megatons in the last quarter. Diving into the REDD+ issuances in more detail, you can see the monthly issuances of REDD+ is split by region in the graph on your screens, and it clearly shows how significantly low the REDD+ issuances were this quarter in the last 3 months. Decreasing issuances from projects based in East Asia and the Pacific is also notable in the darker of the greens. This coincides with Papua New Guinea and Indonesia bringing in moratoria on issuances of forestry credits in March and April this year as they figure out how to meet their NDC targets. Honduras has also followed suit, halting credits in June. REDD+ issuances are also characterized by large issuances from large projects, with the top 4 projects contributing around a quarter of the total REDD+ issuances and leading to the spikes that you can see in the last 2 years. The 4 largest projects, Katigan, Rimba Raya, both in Indonesia, Maya and Dobe in DRC, and Southern Cardamom in Cambodia, are shown on the graph. Issuances from the largest projects have been absent in the last quarter, the largest of these 2, Katigan and Rimba Raya, both based in Indonesia, having had issues halted by the government. The number of projects issuing REDD+ credits has also decreased since the first quarter of the year, with a monthly 15 to 20 projects issuing to 7 to 10 projects issuing since the start of the year. And both factors have contributed to the lowest quarterly REDD+ issuance seen since the second quarter of 2018, at around the same time that moratoria have been introduced. Retirements this quarter have been seen to rally against low retirements last quarter. Q3 has seen retirements rise by 8% on Q2 to 37 megatons. This has brought the year-to-date retirements up 8% on last year's first 3 quarters of retirements. Retirements have held up amid global financial wobbles and continue to track with surprising correlation the S&P 500. The increase in retirements against further financial slowdown this quarter marks stability returning to the carbon market, with nature-based and recent vintages keeping their share of retirements constant over the last quarter. Periods of economic downturn are often bounded in the pattern of falling issuances and stable retirements is not expected to continue. Next slide. With issuances and retirements affected by the financial situation, we expect the short or long-term economic recovery to raise both the levels of issuances and retirements in the future. Next slide. Yeah. While retirements have held up and issuances have fallen, issuances have remained higher than retirements, so that the surplus of the market has continued to grow and now stands at 667 megatons, although the growth has been slower. The growth is now, due to the decreasing issuances, the growth has been the slowest, is at the slowest rate since the first quarter 2018. Red plus surplus, that accounts for a third of the total credit surplus, only grew by 0.1 of a megaton over the quarter, and might be expected to decrease should low issuances continue. Go to the next slide. This can also be seen by the surplus lifetime, the rolling 12-month average period expected for the surplus to be retired at a quarterly retirement rate. While the surplus has continued to grow, the increase in the surplus lifetime has decreased in quarter three, remaining just under 4 years. A big thing we do at Trove is look at future supply of credits. The project pipeline may be new to some of you, but simply is what we call projects that have started their verification process, but are yet to be verified and are unable to issue credits. The pipeline has steadily increased by volume. That is the reported estimated annual credit issuance of projects in the pipeline since the first quarter of 2021, but has sharply rose in the last quarter by 128 megatons, marking significant investment into carbon projects. To put that into context, 128 megatons is the same volume of credits as a whole year's retirements. This increase in the pipeline leaves the current volume at 421 megatons, which according to our research would take registries 10 years to clear at the current rates of registration. For subscribers, this analysis will be available in full in the coming weeks.
Great. Thanks, Hassan. There's a lot to digest there. This chart really is showing where we think the value of the monetary value of the primary carbon market will end up at the end of the year. We made this prediction in Q1 this year, and we just updated it. And admittedly, there's only one more quarter to go. But this is the monetary value in hundreds of millions or thousands of millions of tons. So sorry, that billions of dollars. The monetary value of the primary market in 2021 turned out to be around $1 billion. And earlier in the year, we forecast that the market would grow on average to, we thought, between $1.4 and $1.7 billion due to an increase in both volume and price, with an average of about $1.5, $1.6 billion. So that being a 50 to 60% increase on last year. Due to sort of the changes in the first half of and first 3 quarters of this year, we've now revised that number down so that the monetary value of the primary market, which is retirements multiplied by price for every single project type, to be around $1.2 billion. Now that hides a couple of trends. On its face value, that's a 20% increase in monetary value from 2021. But if we look back at the nature of what caused that demand in 2021, a significant chunk was actually crypto carbon transactions, which took a chunk out of the market. And if we look at the relative growth, if we assume that's not going to happen again this year, and it being a sort of one-off event or type of event, then the relative growth from where we were last year without that transaction, so the core retirements for end users, that we would be looking at a 30% increase in monetary value from where we were last year to where we expect the market outturn to be this year. And taking that into account, the actual volume of retirements is likely to, we think, to be similar to last year at about 166 sort of millions of tons, but an average increase in credit prices more than offsetting or adding to that to create the uplift in total monetary value. And I think, a lot of observers will feel that that's what they've seen in the market. The economic climate is unavoidable. It's not just affecting the voluntary carbon market, it's affecting many other industries. And, there's a sort of storm that we need to just weather through, and then, hopefully the market will pick up the trend of increasing voluntary climate action in the corporate sector where it left off maybe next year. So that's sort of some scores on the doors. And I'll hand over to Gregoire to just give us an update of what's been going on the pricing side.
Thanks, Guy. Am I good on sound? Okay. So as some of you may well know, credit prices have stagnated ever since the start of the war in Ukraine and the recent global economic slowdown. And while they haven't always directly correlated, they have generally tracked equity markets. Now, overall, volume-weighted average prices were averaging around $9.5 per ton in the Q1 before the Ukrainian war. They fell amid the outbreak of it, before stabilizing between $7 to $7.5 on average between mid-May and early August. In the last quarter, we saw a little spike in average prices in August due to some large RED+ volumes and relatively low volumes of renewable energy trades compared with business as usual. And since August, prices have dropped materially to hit a year low this last month, with prices sometimes dipping below $6 per ton. Now, it's worth noting that the prices shown on the slide are monthly. So subscribers to our pricing platform will have seen prices now starting to rise back up, rising above an average of $7.5 per ton in the last few days. Although they obviously remained materially attached to outside forces. And it's worth also emphasizing that these volumes are, these prices are volume-weighted average prices. And we are still seeing some retailers and traders out there selling at much higher prices in certain trades or specific projects. What's interesting is that the average vintage year of underlying trades has quite consistently increased over the last year and the last quarter. As you can see on this chart, the volume-weighted average of the vintage year of credits being transacted, which is now around 2018, has risen up from mid-2016 at the start of Q3 2022. This increase is partly due to new vintages rolling in and older credits being retired, but it's also indicative of buyers preferring more recent credits, as potentially the focus on quality increasingly feeds into the front of market participants in their minds. Now, looking at specific project types, although buyers have been buying more recent vintages, like I said, in the last quarters, we have seen a shift to lower priced project types, with renewable energy credits by far being the most traded. Nature-based projects have maintained a clear premium throughout the year, ever since COP26 to be specific. And this premium is poised to increase as the market rallies around removal techniques notably. In fact, the axis on this chart is looking at month. But again, if you're subscribed to our weekly data feed, in some weeks, prices broke through $15 and $16 per ton for nature restoration, which are essential removal credits in June and July. We've seen a bit more volatility in energy efficiency as far as reduction technologies go. That's notably due to fluctuating liquidity around clean cooking projects, which were quite popular over the summer, for example. And then much less volatility in renewable energy, which, like I said, still constitutes by far the bulk of market trades on most weeks, and which has gathered even more attention during the economic slowdown. And if you have any questions about any of that, please feel free to ask in the chat, and on to you, Delphine, for policy.
Thank you, Greg. I will now take you through some of the key policy developments from Q3. Looking back to August, Gold Standard and Verra announced partnerships with Singapore. Singapore-based companies will be able to meet part of their carbon tax obligations with Gold Standard and Verra credits. This could significantly increase demand for voluntary credits as more countries look to use them to meet their own Paris Agreement targets or allow companies to meet compliance requirements. In September, the Science Based Targets Initiative launched its forest, land and agriculture sector guidance for companies to set targets that cover land-based emissions and removals. Companies must set targets where these emissions total 20% or more of overall emissions, and those with existing targets who meet the criterion must recalculate their targets to include flag targets by the end of 2023 or 2024. An important thing to note here is that unlike non-flag targets, land-based removals from a company's supply chain can be used to meet flag targets, which may reduce removal credit demand. The UNFCCC's Article 6.4 supervisory body,
held its second meeting, proposing eligibility criteria for methodologies and removal activities under the Article 6.4 mechanism, including permanence of between 40 and 100 years and the use of 10-year accounting. The significance of remaining discussions makes the timeline for implementation uncertain. Race to Zero significantly tightened its membership criteria in June, and some signatories felt that they were not sufficiently consulted. Several US banks are reportedly considering dropping from the Glasgow Financial Alliance for Net Zero over litigation risks associated with prohibiting new investments in coal. Race to Zero has since revised these criteria in September to allow signatories to follow other credible pathways for phasing out coal. Lastly, the Integrity Council for the Voluntary Carbon Market released its draft core carbon principles to create a market-wide benchmark for high-quality carbon credits across different registries and project types. There were over 5,000 responses to their public consultation. This could delay the timeline for implementation. Next, we will dig a bit deeper into the feedback on the CCP's consultations. The vast majority of respondents recognise the need to create a benchmark to identify high-quality credits and raise the overall quality in the market over time. As we discussed in our previous webinar, the ICVCM's proposed benchmark is quite stringent in relation to existing projects. Our analysis demonstrated that no credits currently in the registries would meet the CCP criteria. Focusing on the major registries on the slide, Verra Gold Standard and ACR all noted the lack of consideration for differences between project types. For example, not all RED Plus projects could meet the requirements for the financial additionality test, as most do not disclose investment analysis. This creates a risk that high-quality projects under current standard may lose critical financial support and fall out of the market. Verra was the most critical of the three registries, arguing that the ICVCM is not working with programs, but threatens to replace them. They call for the ICVCM to instead issue assessments only at the program level. While we think it is unlikely that the ICVCM will go down this route, we believe there is a need for a bridge between current best practice and the initial threshold of the proposed CCPs. Another key area of interest is the Red Dot Plus initiative. I will now hand over to my colleague, our Head of Forestry, Teresa, to discuss our recently published assessments of its implications for the market.
Thanks, Delphine. Red Dot Plus is a new platform offering Red Plus carbon credits. We want to cover it here briefly as there has been a lot of discussion around what Red Dot Plus is and worries on whether these credits may indeed quote-unquote flood the market. Red Dot Plus was launched by the Coalition for Rainforest Nations and it features country-level carbon credits. But unlike jurisdictional scale standards such as Art-Trees or Verra's JNR, they did not actually develop a methodology. Instead, what it does is it uses emission reductions reported to the UNFCCC under the Warsaw Framework for RED+, which is part of the Paris Agreement. Red Dot Plus and participating countries convert these reported emission reductions one-to-one into what they call RED+ result units, or RRUs. A few countries are engaging with Red Dot Plus right now, but only Papua New Guinea has issued any credits so far, which was 9 million last year. Gabon is planning to issue another 90 million credits before the end of this year. Our deep dive into Red Dot Plus at Trove, however, has found that there is a range of methodological risks and other red flags that currently severely compromise any credits issued. Most of them directly relate to the fact that the Warsaw Framework for RED+ was never designed as an offset program. The methodological rigor at the level of the individual ton CO2 reduced is relatively low. There is a risk of baseline inflations and poor quantifications. Not only that, together with insufficient validation and verification in the system, Red Dot Plus also has a lack of permanent safeguards. It has no buffer pool and no uncertainty deductions or monitoring for reversals. To be clear, these are all the ways in which in the voluntary carbon market, the integrity of RED+ credits is protected in case something happens to the forest in the originating project. Red Dot Plus was rejected from CORSIA eligibility twice. The UNFCCC Secretariat doesn't recognize UNFCCC references the Coalition for Rainforest Nations use to legitimize their program, and there's significant uncertainty on free, prior, and informed consent and the lack of transparency on the distribution of funds. Given the numbers on Trove Intelligence, it seems that the market does not trust Red Dot Plus. In the last 1.5 years since the credits became available, only 20,000 of them have been sold, which compares to over 57 million retirements of REDD+ credits from the VCM in the same time span. The supposed flooding of the market, it hasn't materialized yet, and we do not believe that the issuance of even more of these RRUs, these credits, is going to change that. To finalize this, we want to be clear that there's no intrinsic problem with developing markets investigating new ways to raise funds for their forests. These are our concerns with REDD+ itself. As it stands right now, these credits are not rigorous enough to offset or compensate for emissions, and as it stands, we do not recommend that they are considered equivalent to high-quality project-based or jurisdictional REDD+ credits. Now, our work on REDD+ notwithstanding, there are a few updates to existing forestry-related methodologies in the VCM, which we can look out for in Q4. On the one side, Verra has released revisions to its VCS avoided unplanned deforestation and/or degradation methodologies for public consultation. This is part of a long-term movement on Verra's part to make things more jurisdictionally aligned, consolidating Verra's REDD methodology. On the other hand, the American Carbon Registry announced a new methodology for avoided conversion of non-federal US forests to alternative land uses. It's a shift from existing methodologies currently available in the US. Apart from that, of course, a significant focus will be on COP27, in particular discussions on Article 6.4. There could be a decision on whether emission avoidance and conservation enhancement will be eligible for Article 6.4 for the Article 6.4 mechanism. So that's definitely going to be interesting. There will be further discussions from the SBTI on beyond value chain mitigation in Q4, and the guidance will follow in 2023. And last but not least, of course, we will also be tracking Verra, Gold Standard, and ACR as they deliberate frameworks for the creation of digital tokens representing carbon credits. So quite a few things to look out for.
And handing back to Guy for the next section of our webinar.
Unmute myself. I'm unmuted. Great. Some people here want to mute me more often than we get on the webinar. So yes, as is our tradition, we've polled the market twice now in Q1 and Q2 for your views on where you think the price of voluntary carbon credits will end up at the end of the year. And these are the results that we picked up that you've given us so far. So the lighter pink one says we ask for where you think the price of 3 types of carbon projects are going to be: renewable energy efficiency, REDD+, and nature restoration. And so far, you've given us a reasonably consistent view of where you think renewable energy efficiency credits are going to end up. Skewed towards the left, not much difference actually between Q1 and Q2, with a median of around $7 to $10 a ton. Interested to see where you think it's going to end up now. REDD+ in Q1 was pretty bullish. The median price around $15 to $18. Some people thinking it would go up as high as 20, 23, 26. But then in Q2, as the economic sort of climate started to change, that shape of distribution of where you thought the price was going to go skewed more to the left, 7 to 10 and 11 to 12, 11 to 14 being the most sort of common outcomes that you told us. So a sort of a shifting of the skew to the left on REDD+ from Q1 to Q2. Nature restoration, again, there was quite a lot of commonality between Q1 and Q2. Still, very different distribution, a right-hand skew towards the way you think nature restoration projects are going to come out. Certainly the majority thinking there would be above $15 to $18, but the median price being in the sort of 18 to 19 range. So I think that that trend that you told us before sort of chimes with a view that the nature restoration, the removals part of the market has an identity somewhat different from other project types. But that's me summarizing what you told us for the first 2 quarters. I don't want to lead the witness too much in what you tell us now. So give us your best guess as where you think these 3 project types will end up in the different price categories. So Tanya, can you?
Yes, you will just now have seen a poll pop up on all of your screens. Please answer to the best of your abilities what you estimate carbon credit prices will be at year end.
The others thinking.
We'll give you another minute or so to bring your answers in. And you should now be able to see the results up on the screen.
And Tanya, are you going to try and work some Excel wizardry in the background while I answer a few questions so that we can sort of compare them Q1, Q2, Q3?
Absolutely. So in the meantime, Guy, I do have a question for you from our audience. Guy, at the beginning of the webinar, you highlighted that the number of companies committing to set SBTI targets in the next 2 years dropped in the last quarter. Do you know why that is? Or do you have a view on how many more companies will set new climate targets?
So that drop was the SBTI committed category, which is a slightly odd term they use. It actually means intention to commit. Why has that fallen? I would guess it's linked to the strongly linked to the economic climate. And as I also said, we've also seen the number of companies making those longer term commitments increasing yet again. So the cause of it, I can't unpick. Are companies getting cold feet on this? I don't think so, at a macro level, but I think the next quarter is going to be really, really interesting. So stay tuned in January where we look at the Q4 numbers, and we'll see where whether that is a blip, a downward blip, or a permanent trend.
Guy, you're now able to move forward. We have our Q3 results ready, and you can make some comments on those.
Oh, okay. Real-time analysis. Let's look at renewable energy efficiency. Look, there seems to be a generally similar pattern of distribution of price outcomes. The 3 to 6 band has got more weighting now than in previous quarters. The higher ends, the optimists out there, a few of them still hanging on to 19 to 22, 23 to 26, very small levels. The mid-range that are staying constant. I think the main shift that we're looking at is the $7 to $10 crowd, perhaps shifting to the 3 to 6. The more, the bears seeing more of those lower priced transactions coming through on that project type. Red Dot Plus seems to be pretty similar, more concentrated, more a more concentrated view of the mid-range prices, $11 to $14 now, with lesser tails on the low end. Right, 3 to 6 has increased, 7 to 10 remain the same, but a contraction in the number of people. If you look at the higher price, 19 to 22 or 23 to 26, the number of participants, proportional participants, has fallen quarter on quarter, looking at, expecting an outturn in those higher price brackets. So, the median 7 to 10 and 11 to 14 being the most popular now. Nature restoration, same sort of right-hand skew on the distribution, fairly similar all round, particularly in relation to Q2. There was this change in the higher price brackets from Q1 to Q2, but Q3 seems to be pretty similar to Q2. Looking at a median, just eyeballing this, sort of 18 to 20, or sort of around about $18 being the median price outcome for the nature restoration category. So we've got a pretty good distribution for each project type. We've got a reasonable pattern over time as well. A really interesting group. So thank you, 279. This is probably the most comprehensive, 280, going up, number, sort of like vox pop on where the market thinks the prices are going to end up at the end of the year. As Gregoire noted, there's a lot of variation within these project types, and even as you break it down into sub-project types. So renewable energy efficiency, very, very broad category. For example, cook stoves, trading at very different levels to renewables and vintage types. So there is a very large spread. So we acknowledge that these are very, very broad averages, but I think do capture a trend and a pattern over time. So yeah, do contact us, please, for more granular information on what's driving these and where prices are likely to go in the short, medium, and long term. Great.
We will now begin the Q&A section of our webinar. If you haven't already, now would be the time to use the Q&A feature to submit any queries or questions that you might have. Guy, I've got another question for you. We've also received a lot of questions around where we think market prices are going to go, both overall and for specific project types, such as nature-based reduction credits. For example, one member of the audience asked what we think will happen to prices after COP27. So Guy and maybe Gregoire, if you'd like to have a shot at answering that.
Well, we do provide price scenarios. I would like to sort of clarify that forecasts are tricky, particularly in this market. And I would also like to draw attention to our disclaimer. Is it on this? That we are not regulated to provide investment advice, so anything we say, should not be used to back particularly on these webinars, back a specific investment. It's a very tricky. It's a very tricky question. I think the most powerful dynamic that we're going to see affecting prices is this shift to quality. There's the macro trends of demand and supply, the volumetric side of things, but within that, the consistent question we're being asked is how do we price the best quality projects, the most desirable ones, the ones that are going to have greatest environmental and social impact, both from the demand side and the supply side. And I think this talks to that previous chart, which shows the expectations in the market of the price of restoration credits holding up, even in this sort of challenging economic climate, which is indicative of the ongoing demand and interest in really supporting projects that are going to make a difference. That's a very vague answer, I'm afraid. And if anyone was expecting me to say, it's going to be a sort of X dollars or Y dollars, I'm afraid I don't give that. Gregoire may have a better insight, given that he runs the pricing team.
No, but just a slight add-on to that is that prices are it's very possible they'll reach a new plateau after COP27 because the market is really prone to, very sensitive to safety as it is perceived through policy and international conversations, things like Article 6. But given the current economic conditions, there's no, we don't have a crystal ball for that, right? It's not certain, but it could definitely reach a new plateau again, like with COP26.
Thank you so much for answering that. I've got a question for either Hassan or Guy now.
Yeah, I can take it. Yeah.
Do we have any views beyond the country moratoria about what has caused the REDD+ issuance slowdown?
Yeah, it's an interesting question. And we can really only speculate at the moment. I think given the financial situation we're in at the moment, there's quite a lot of cautiousness for issuers in terms of issuing credits, especially to bear in mind that, as I think I mentioned, the REDD+ surplus is already quite large at over a third of the whole market surplus. So the kind of impetus behind issuing new credits isn't really there. It's seen more as a threat by credit issuers, perhaps. We do also see an increasing trend of simultaneous issuance from retiring. So we could see that it's become a bit of a trend, perhaps, that people are only issuing once they have a retiree in mind or have already arranged that, which would kind of stem the flow of issuances. And we have also had some comments from the supply side players. Verification standards have stepped up, and the verifiers are taking longer, which is more of an issue of credit or emissions reductions verification more so than issuance. So I wouldn't expect that to have affected the issuance levels too much. But that's also important to bear in mind in terms of what credits are becoming available.
I have a question maybe for Teresa regarding REDD+. We've had a few comments agreeing with your analysis. Someone has asked how the 20K that has traded can be tracked. Are the transactions on one of the established registries? Can one see who the buyers are?
That's an excellent question. So actually, since we're doing a lot of things live and ad hoc today, I called up my very lengthy notes on this. So here's what we do know. We do know that IHS Markit administers the registry, and Expansive CBL administers the trading platform. So this is not a case where you can go like on Vera or Gold Standard, you can see these credits live being there, these RRUs, REDD+ result units. When you go into the actual data, what we can see is that most of the transactions on these units are less than 20 units every time. There's loads of transactions that are just like one credit, and almost every single one of them is coming from the original like Coalition for Rainforest Nation platform, which means that it's actually not recorded who is the end consumer of these credits, who's the end receiver of these credits, just that it came through the original platform. So can I tell you that where these credits went to? For most of them, I cannot. There's an exception. 2 original transactions were put towards a Canadian company that's sort of an environmental service company that uses the credits to actually retire against emission reductions. So this part we know. Other than that, it's many very, very small transactions with what I can only assume individual people or micro entities buying credits if they do want to use it against their emission reductions.
Thank you so much for that answer, Teresa. I've got another one for you, Guy, one that I think you will find quite interesting. We've had quite a few questions around Article 6.4. One of the listeners has asked us if we think the VCM might become a removals market only. What are your thoughts on that?
Yeah, good. I think there's 2 answers to that. There's the theoretical answer and the practical one. The theoretical argument is that all reductions, which has been long held by a number of the scientific community and NGO community, that all reductions should theoretically fall under commitments, either governmental and or corporate commitments, and should be part of scope 1, 2, and 3 mitigation pathways. And so if every entity, a corporate or a government, does what it says it's going to do and should do, then they should all be within supply chain emission reductions at somewhere in the world, at some point somewhere in the world. So it's only when all of that is being achieved that you start to look at removals to then remove what residual CO2 there is in the atmosphere. And that's why the SBTI and the scientists have said that there needs to be a focus on neutralization, i.e. removal of CO2 when that mitigation action has happened. But the practical answer is really, there's a heck of a lot of impediments to doing those reduction activities, governmental level, corporate level, and the more capital that can be devoted to achieving those reductions, laying claim to those reductions, and sort of facilitating the overall and increasing the overall amount of capital that flows into them, is probably a good thing. And an example would be where there's an aspirational target or sort of aspiration of a reduction target at some point that is being set by a government or a corporate, but really is only that. It's an aspiration. And I think sometimes in this market we can be forgiven for thinking that just because someone has said they're going to, there's a target of 50% reduction, 80, 90, 100% reduction, that will be achieved at, come hell or high water. And I think the practical reality is that it's incredibly difficult to do that, particularly under a scope 3 sort of supply chain framework. And so I think that the practicalities is that investment in reduction activities is where the focus needs to be. And if the voluntary carbon market can direct resources to that alongside removals, it will probably be doing the right thing.
And sort of just adding on to that question, another viewer asked if we have a view on how corresponding adjustments might impact the market and market prices. Yeah, so we've written a lot on this. We produced our first sort of thoughtful commentary on this back in January 2021, and we did some work sponsored by Environmental Defence on this in terms of implications for tropical forest countries, which we published in the summer as well. Let's as Teresa said, let's focus on what we do know. What we do know is that there are a number of parts of the market that absolutely categorically require corresponding adjustments under Article 6.4. And that is the CORSIA scheme for international airlines after 2027, and any credits that are used by an entity that would be used against a target, an NDC, be it a corporate in a compliance framework that gets rolled up to a national account or a government. So all of those uses of the credit do unequivocally require a corresponding adjustment. We are actually doing some work, and we'll publish very shortly our thoughts on what the price of those correspondingly adjusted credits will be for those entities. So watch this space for that. As per their use within the conventional or voluntary carbon market that we see today, I think the jury is still out. And I suspect that jury will not convene and rule categorically for a long, long time. And I think the market will find its own route as to whether or not the corporate world voluntarily will require or be seen to require a corresponding adjustment. My guess is that it won't, and that the pragmatic view of corporate capital, discretionary corporate capital, will be put to where it's most effective to reduce emissions, be it within or without a supply chain, and that the benefits of that from a carbon credit point of view will flow back to the financiers of those projects. And my sense is that will not require a corresponding adjustment, but we are going to be objective and put the evidence down for both all outcomes. We've had a lot of questions asking for more detailed analysis on pricing. I just would like to say that we do have a lot more pricing data, both in granularity and frequency of data. This is available on the Trove intelligence platform that subscribers have access to. I'll pick out one of the many questions and ask, how are vintages currently impacting market prices? Would Guy or Greg like to take that question?
I would. Greg, you're going to have a first stab at that?
Yeah, I'm sorry, you just have to repeat it for me.
How are vintages currently impacting market prices?
So we are seeing clear differences. We've almost always seen clear differences in prices according to vintages. Now, we like to separate them into bands or categories because that's when the clear trends emerge and you cut through the volatility. We currently divide vintages as 2012 and before, 2013 to 2015, 2016 to 2019, using Corsia as a cutoff, and 2020 plus, right? So I don't want to spend too much time on details, and feel free to reach out for access to granular views, but the big idea is that you are seeing very, very clearly lower prices for oldest vintages, right? Anything before 2012, and then much higher prices for everything else. And like I was saying earlier, we personally think that most recent vintages, 21 and 2022, have not quite shown a premium over the years right before that, but that will happen, right? Vintage is a clear sign of quality for buyers, and that will remain true and probably even more so in the future.
I'm really useful, and Gregoire's team does a huge amount of research and analysis and publishes the data on a weekly basis on a lot of these trends. I'm also going to stick my neck out a little bit here with a perhaps controversial view that will say that vintage premium for the more recent stuff will accelerate. And the reason for that is that when you look at the work that the ICBCM is trying to bring forwards in terms of higher benchmarks for standardized quality control on the whole process of creating a carbon credit, the reason why a lot of the projects, maybe all of the projects currently in the registries, do not comply with those really, really tight high bars is because they weren't designed to originally. So retrospectively applying those CCPs under the ACDCM to projects that were generated 5-10 years ago is never going to work. But that doesn't mean that new projects going forwards can't comply with those requirements. And a lot of them are to do with disclosure. They're not necessarily about the the fundamental investment sort of pitch and work on the ground. It's about the amount of information that was captured and disclosed at the time, which means you just can't assess them against the criteria because the information doesn't exist, because those projects were done too long ago. Going forwards, if we see projects now, the developers disclosing through the registries and the methodologies and the verifiers and all of that documentation, that they can now lay claim to this much higher bar because they've just prepared for it in time, that could, in theory, create a new standard, a new high watermark on quality and integrity that those newer projects will be able to lay claim to. And I would be very interested to see how the market reacted to that.
I have just one final question, perhaps for Guy. Several people have asked us this. Guy, will Trove be at COP27 this year?
Well, Tanya, I'm glad you asked me that. Yes, we will be at COP27 for both weeks. And we will have quite a few people there. We think this is a really important COP. I know a lot of pressure and a lot of emphasis was put on COP26 in Glasgow, it being the 5-year anniversary of the Paris Agreement, but this is also really important as well. A lot of claims, a lot of commitments were made in COP26, and the world has, the climate evidence, the temperature charts, the floods have got even worse. And, a lot of the scientists are saying, we have to make progress. Let's stop the talk and let's create action now. And the clock's ticking. And, I do feel that this is a really, really important COP to cement the commitments and show progress. and we will be there in force to support that.
Thank you so much for answering that, Guy. Thank you everybody for joining us for our quarterly VCM review. I hope that we were able to provide some key insights into the voluntary carbon market. Please follow our LinkedIn to stay up to date on any upcoming webinars. As Guy so eloquently mentioned, this coming COP27 is a very important one, an important one for action. And our next webinar will take place in the aftermath of COP27, so watch this space. If you'd like to book a demo of our platform and find out more about our data and analysis, please contact us at subscriptions@trove-research.com. Thank you, everybody.